This is for the assignment one on the course 4314, which is for the risk management course. It is a great pleasure here today. We invited the guest for Mr. Chen. He's a friend of mine. He's been working in the risk management industry for more than 5 years. This is pretty much his career path. Started as an economist in Statistics Canada, and working as a quant analyst for about a year, and then moving to a commercial bank, and then a pension fund for risk management professions. Right now he's a research fellows for the National Institute of Aging. So we pleasure to invite him here today to talk a little bit more about his career journey and how did he switch it to the career path on the on the risk management.
First of all, thanks for having me here today. It's my pleasure to share my experience and some ideas about the industry. So look at the agenda. First question you have for me is share more about my career journey. How did I choose to switch my career path to risk management? Okay, so that's so I had an interesting career journey. I didn't start in finance at all. So I started in federal government, and then I was a contractor there. And then when my contract ended, I happened to find a job in a hedge fund. So that's how I stepped into finance. So as a quant analyst, all I did on a daily basis was to code, so to program. My duty was to basically turn my trader's idea into reality from coding and programming, and to backtest the strategies to see if they are profitable, and then we turn the strategies into life to make real money. I never saw myself as a programmer, but then every day I was coding for 8 to 10 hours, and that's a bit of beyond my capabilities or imagination on myself. So that's why after a year and a half, I decided to switch to something that is more of a I would say that is less of a coding or programmer type of job. So that's how I stepped into risk management. So that's about me. So I'll go with the next question if you don't have anything for me to ask.
I can start with the question number 2, actually. So, I mean, during the past 10 years, you have been working 5 years for the for the risk management industry. So, to you, what are the most important characteristics and the knowledge piece or the skill sets required by the risk management industry?
Yeah, that's a very good question. So let me just finish what I didn't finish for question 1. So when I was working for the hedge fund, I was only looking at equities, so equities tradings. But then I wanted to do something else. There's like other asset classes. So stepping into risk management broadened my view and I would say expertise and experience in other asset classes. For example, I also look at IR, commodities, credit stuff, and FX. So I would say, to answer your question, the number one important characteristics is you have to know your stuff. So basically what I mean by that is you need to know the entire financial markets, not only equities. Like we all trade equities, we all trade stocks, but then that's not enough to be a good risk manager. And then second of all, I would say you need to be IT savvy. Things are very different now from 10 years ago, or even like 20 years ago, because every day we are doing stuff involved with IT, technologies, systems, fintechs. I'm not saying that everyone needs to be a professional programmer, like I am not myself, but then you need to know the basics. For example, the SQL, Python or SAS or R or anything, right? You need to start with some programming languages so that you are able to at least retrieve data from the database and then to play around with the numbers. 3 is so as a risk manager, to be honest, how we add value, there is a major component is we are able to communicate with front offices. with people who make the trades, with portfolio managers. We act as advisors to them to let them know their real risks, both quantitatively and qualitatively. So being able to communicate in plain languages, that is a very, very important skills as a risk manager, because sometimes they don't understand your languages, because if you talk to them about VAR, about expanded shortfalls, they don't necessarily know. You need to be able to tell them what this really means and how they should adjust their portfolios to become resilient to potential market movement against our holdings. So last but not least, this is also related to number one, you need to really know your stuff. There are emerging risk types in the market. There are a lot. For example, I'll use a very simple example, climate risk. So if you look at the, at least in Canada, the pension funds or banks job description, you will notice they added a section about how important they treat climate risk and other ESG factors in their corporations, right? So this is going to be another new type of risks, and people, including risk managers, we only know so little about it. So right now, the understanding of this type of risk is only on qualitative level. So quantification of ESG risks or climate risk in specific would be the next big topic in the next decades.
Yeah, but it's still in a big mystery boxes of the, let's say, the climate and the ESG stuffs, because there's no specific, well, there's some ambiguities on the how the definition going to be given on those type of risks. That's why it cannot be strictly be quantified. Is that, am I understanding is correct, or?
Yeah, exactly. That's absolutely what it is. So people, I would say, to answer your question, not everyone has the same understanding of what climate risk is or what ESG really means. People know what a VAR is, people know what a market risk is, people know how to measure market risk, but the understanding of ESG is different based on your experience, your investment process, and your governance. So before we get to quantification, we need to really make everyone on the same page so that we are all talking in the same language.
Yeah, so I know that right now you'll be working on the the National Institute of Aging, right? So is that something specifically related to the aging population? Are there any type of risks coming through? I mean, globally, there's aging populations now, not only in North America, but across the globally, right? So are there any type of risks or solutions to deal with those type of risks, you saying, or it's still undergoing?
Yeah, absolutely. So aging is a big topic, not only in Canada, not only in North America, but also in the entire world, right? I was reading another study report saying that basically in North America, the biggest aging population coming is the baby boomers, right? In China, there's others. In Africa, there's others. But then in general, the aging population is really growing, while the fertility rate is declining, right? So we are going to experience a change of structure in demographics in the next decade also, right? So if we focus on North America or Canada specifically, that's what my institution is doing. So we are the only institution, nonprofit institution in Canada. We belong to Rising University to study the population and how to provide the solutions. So to answer your question about the solutions, I would like to refer back to my experience in pension funds a little bit. So I started in Ontario Teachers, and then I went to BC Investment Management Corporation for some time there too. So the role of pension funds, basically, there's only one role or ultimate goal, is to provide pension supports to their members. And how do they do that is very, very different. Okay, I'll give you an example. Ontario Teachers, OTPP, they are a single client pension. All their clients, there's only one federation, which is the teachers, high school teachers, primary school, middle school teachers in Ontario. So they only serve those. They only serve them. But in BCI, is a multi-client nature. BCI has over 35 clients, and then out of the 35, there are about 30 that are pension related, right?
Yeah.
So what I mean by that is one most important aspect in pension management is asset liability management. It's very easy to understand what asset is, because asset is how much money you have and how much investment return you have from investing your money into either primary markets or secondary markets. But then on the liability side, that's what I am specializing in currently. That is something that you need to really understand. So still using this example, Ontario Teachers has a 1 to 1.3 active and pensioner ratio. What that means is one currently working profession or one currently working teacher is supporting 1.3 retired teacher in Ontario. What that means is OTPP really needs to take a lot of risks to make sure they have adequate return to support the 1.3 retired teachers in the next 10 years, right? On the other hand, if we look at BCI, there are like more than 30 clients, as I mentioned. Every of them, they have different asset liability structure. So for some clients, they have, for example, 3 to 1 active to pensioner ratio. That means 3 working profession is supporting 1 retired member collectively. What that means is for that specific client, BCI is able to invest more conservatively instead of aggressively, because they don't have to reach that high level of return compared to Ontario teachers, right? So this is something called a liability-driven investing. You need to understand your liability and then make sure that people receive adequate pension after they retire. And this is actually a big risk for DB plan sponsors. So basically, Ontario Teachers, AIMCO, Alberta Pension, BCI, CPP, they are all DB pension providers, and there's a risk on them. So what I am studying right now is, because of this risk on DB pension sponsors, there are less and less DB coverages in Canada. That means less risk for DB sponsors, but more risk for retirees, because they have less coverage, they have less stable money from the DB sponsors, right? So this is what I'm studying currently, is to help. So basically, we are reinventing, I would say. This is not something we invented, but this is a concept that has existed for like, I don't know, 50 years, but they're not really popular in Canada. So we're reinventing this, something called a dynamic pension pool, which is a combination of DC and DB plan to both reduce risks for plan sponsors and increase stable cash flows for retirees. So put it simply, we are helping Canadians to invent something called a pool to invest their lifetime savings and turn that into lifetime incomes, so that they don't have to worry about their life expectancy. Like, some people worry about, if I die too late, right? But I don't have enough money to support me. Especially when people reach their 80s or 90s, they have a very, very high healthcare cost.
Exactly. Yeah.
Right. So how do they deal with that? So what we are doing now is to create this type of pool, so that people can pool their money and mortality rate, and then this will provide them a stable lifetime income.
Yeah, because my understanding between the risks and the return, there's a trade-off between them, right? So if the risk is too high, you're going to invest it aggressively. Apparently, like in short term, there are some more volatilities or fluctuations of your portfolio. Another way of saying, let's say compare between BCI or OTPP. So if the ratio 1 to 3 compared to 1 to 1.3, so basically, is that BCI is more risk tolerance compared to OTPP to some extent? In the short term, right?
Yeah, that's right. Yeah, but then like all pension investors, they say they focus on long term. So
yeah, every patient saying so. Yeah. Thank you so much. Hey, and it's well, I still need to your disclaimer of it's okay. I upload this videos to YouTube. I hopefully, well,
Oh
hopefully,
yeah, for sure. Mhm.
yeah.
No
There's
problem.
no disclosure of any company or any like for example confidential informations or material informations in our conversation, right? We just want to make sure that at this
No,
stage.
no, not really. Yeah, everything
Oh,
can be found in the public Google search.
okay, cool.
Yeah,
Thank you so much. Let me
no
just
problem.
pause the recording here.